I don't know if we're past maximum pain. You know, I think that there's still risk that the economic consequences are going to cause markets to be hesitant, but it's going to be hard to match that fear again. So I think a structural low did take place.
Stocks are attractive, but uncertainty is still the name of the game, and it's going to persist.
Yeah, I think it's going to be hard to match that level of fear again. So I think we're probably past peak uncertainty. I mean, even with this Fed controversy, but I think that there's a chance we could be drifting dangerously close to that again. Bitcoin earlier this year may have been struggling with some of the deleveraging that was happening for institutional investors.
Just selling what they could.
Yeah, selling what they could, and I think that suppressed Bitcoin, especially over weekends. But now that deleveraging is done, I think that Bitcoin is going to catch up to gold, and you know, Bitcoin's old high was over 110,000. So I think there is a lot of room to catch up as a sort of non-dollar asset.
Financial analyst and Bitcoin bull Tom Lee breaks down what's really happening in the market and why we can expect the market to see maximum pain before this is over. Lee recently shared his prediction for Bitcoin and the economic uncertainty we're seeing. With tariffs and recession fears creating market volatility, Lee suggests that a major market rally is on the horizon, and that's where Bitcoin comes in. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. Bitcoin's price currently sits just over 87,200, up almost 4% in the past week. Lee points out that markets have bottomed historically before major events resolve, so we could see a sharp recovery within the next week. The bottom line, Bitcoin's next big move depends on how this plays out. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
Does the S&P have a closing bear market low from here? What are we down, 14% now, something like that?
Yeah, I mean, 4,800 was the low we made a couple weeks ago, because there's still probably a lot of investors sitting on their hands and there's uncertainty. But on the flip side, I just think that we have to keep in mind that, one, companies are very resilient, and we'll learn about it during earnings season. But we could have a positive policy shock as well.
Like a backing off of some of the tariffs? Yes,
we could have something that the market sees as a win. Whether it's going to be one of the 15 countries that we have a trade deal with, or a de-escalation with China, which of course overnight didn't seem like that was a possibility, but there is room for a positive policy shock. U.S. and China have absurd levels of reciprocal tariffs at the moment. And if you believe those are in place, then the global economy is in trouble and you should be bearish. We know markets have gotten very pessimistic. They've priced in a 60% probability of a recession. If tariff negotiations de-escalate, then the probability isn't that high. So I think that there's still a big window for markets to have a large rebound, but it's really the path of this de-escalation.
We're in a bear market. I mean, we're in a bear market, right? It's like so many stocks got just absolutely destroyed before this uncertainty happened in the market.
Yes, I mean, if we define a bear market as stocks feel like a grind or you're losing money, I'd say it really started in December because markets were churning even through the February high. But if I was to define a bear market as unleashing a type of financial tightening that leads to a recession, but I think it feels like a bear market for the average person. I mean, I think there's sort of two brains people are fighting. One is the tactical brain, which is, look, they want to know if this is a bottom, and they want to be convinced of it by seeing stocks rally on bad news. But if someone had the investor hat on, and that's the long-term brain, I have a lot of confidence the U.S. companies are going to navigate through this treachery. Stocks are hugely oversold because you never really lose money buying the VIX at 50, or when the percentage of stocks above the 200-day drops to 15. Those are almost guarantees of positive 1-year, 3-year, 5-year returns. So it depends which brain you're wearing today, but I'd say the majority of our clients are trying to be tactical. But if this is a matter of who makes the overture first or blinks, but we know it de-escalates, then I think the downside has largely, it comes off dramatically, and I think stocks can actually do really well into the rest of the year. But yes, I would be buying stocks today. One of the things we did for our clients last night is to look at what's called, Walter Deemer calls sold out stocks, which is worse than oversold. Sold out stocks don't go down because there's a lot of bad news priced in. Mm-hmm. There's a lot of stocks that didn't make new lows on Tuesday, April 8th. They made their lows a month ago, and they had lower volume on April 8th. Those are what I'd call washed out stocks. A group that I think is washed out is the Mag 7. So I'd look at Mag 7 as a place to really expect a rebound, including stocks like Tesla.
Okay. We're left with the rubble, decision making in the White House. And the damage has been done. CEOs have no visibility whatsoever. Do you see this consumer sentiment number today?
Yeah, they're awful.
Do you see where inflation expectations are?
Yeah, they've gone bananas.
Do you see what earnings expectations have done recently?
I mean, there's no ability to make guidance.
So what if the damage is already done now?
That's right. Now, we have to keep in mind this has been 10 days. So it is a shock, a high-amplitude shock, but only of 7 days, so someone can restart the patient's heartbeat. I think that the White House is now keenly aware that Main Street can't handle a huge deleveraging because it is going to lead to job loss, and he's listening to CEOs. So I think there's a really big window to repair the bulk of this damage. And at the other side of this, of course, is that we have reciprocal tariffs in place that are acceptable. We have tax policy that's changing and less regulation. So I actually think the 2026 outlook is still quite good.
Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits as we head into the second quarter of 2025. Now we'll hear Tom Lee break down what implications the Fed rate cuts have and the current risks the market faces.
I think there's a call at work and a couple of puts. I think that there is a Fed liquidity put by the Fed.
When Collins said what she did?
Exactly. And we know the Fed put on rates strikes much lower. The White House has a policy put because we know that you can't brinksmanship the global economy to a halt just to try to get China to blink. And I think that the call is, I think there's a negotiator call, which means I think the White House exercised the Navarro call and replaced him with Besson. I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah, and I think part of it is if someone had an investor hat on, not tactical hat, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there, and the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks. I think that if we didn't have to consider tariffs, inflation is definitely tracking below expectations.
I mean, where the Fed wants it, almost.
Yeah. I mean, core inflation month over month at 0.00056. I mean, that's like literally hitting a wall.
Now, is that for good reasons or for bad reasons?
I think it's for the right reasons because...
Oil?
Yeah, well, there's oil and foods off the boil, but it really is shelter is actually cooling to a 2% rate, and that is what you need to get inflation back down to 2.
Do you, at this point, foresee the worst-case scenario in terms of dollar declines, 10-year yields due to people the Journal had an interesting piece today that it doesn't need to be that people just abandon the dollar and abandon the United States to invest in. It's just on the margin, because it's a given that you cannot ignore the United States as the elephant in the room globally for all these things, for the currency, investments. But on the margin, it could make a big difference if there was even a slight lessening of what we were used to.
Yeah, I agree. I think that is the narrative at the moment, that U.S. exceptionalism's over and people are selling treasuries and dollars to buy other assets. But I'm not in that camp that it's sustainable, because unless weaker dollar and higher yields suddenly makes the best companies in the world outside the U.S., the best and the most important companies in the world are American companies. They've produced the best shareholder returns. And, if you look at the S&P, 40% of the returns of the S&P come from new companies every 10 years. Is there going to be suddenly the best new company coming out of Europe instead of the U.S. because of the dollar? And I doubt it. And I think U.S. companies are going to adapt.
He believes the market is setting up for another strong leg higher. Similarly, Bitwise CIO Matt Haugen supports this view, pointing to a dip-then-rip pattern, where sharp pullbacks are typically followed by massive rallies, up to 190% gains historically. Both argue that patience, not panic, is key. Tom Lee challenges the conventional economic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures. The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Lee asserts this journey is just the beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Lee highlights this being a significant development in the financial ecosystem, selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Lee also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Tom Lee? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing?